Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted for this Christmas special to be able to chat to expert stock picker and analyst Paul Scott to talk all things small cap. So,
hello, Paul.
welcome, Paul.
Hello, everyone.
Yeah, well, we've had a lot of big macro news this week, not least sort of big decisions by central banks on both sides of the Atlantic, which sent the markets actually, unfortunately, into a bit of a tailspin. But the big news this week, I understand, is that you've extended your editorial team at Substack with the recruitment of Dave, and also you've got a sort of like a stock picking competition for 2025. So don't you want to say a couple of words about that?
Yes, well, I've been really delighted with the number of people who've converted from free to paying subscriber accounts for my Substacks, which has given me a modest budget to get in a co-writer. So Dave is joining me. I don't really know anything about him other than we met online recently, and he's turning out to be, he's done a really successful trial. He's a very good analyst, very good investor, and I'm delighted to welcome him to the team. My newly created team. So and I'm doing a 2025 share competition as well for the readers. Lots of stuff happening.
What's his surname, Dave? Because I mean, I've read a couple of his articles and I think they're excellent. Actually, they're really good.
I'm not sure whether he wants that revealed just yet. I haven't spoken to him yet about what he wants to say about himself. So at the moment he's just Mystery Dave.
Okay, we'll call him Dave with no name then. In that case,
yeah, no, I mean it's just you can't launch into saying things about people without their consent. So that was all.
Yeah, sure. And then just in terms of sort of like the stock picking, etc., when are you planning to put your top 20 out? Did you say?
That'll be right at the end of the year, New Year's Eve probably. But again, I'm gonna put that through the paying subscriber only, because you can't, if you give stuff away, nobody will pay you any subscriptions, will they? So yeah.
Well, I'm going to put you to the challenge here. We're going to have our pint of beer challenge again, and I'm going to put a top 20 together as well. And they'll be good, because I don't think we'll have that much commonality because we choose slightly different stocks, I think.
Yes.
So I will put a hypothetical top 20 as well and go head to head for you for the next 12 months. What about that's a challenge, isn't it? Throw the gauntlet down.
Yes.
Okay, good. Well, we've got just to put a bit of background then for the sort of everybody's sort of stock picking for next year. I had a question actually from Tortoise investor just asking about the sort of the macro and sort of like key calls, and I'll put a couple of slides here together, so I'll just walk through them and then you can sort of like throw mud at them then, Paul. So we'll start with that. Okay,
I'll move you from my right screen to my left, so far away.
Okay, well, I've got the ones on the screen there. So basically, I think it's pretty obvious that Trump is going to put some import tariffs, which is going to unsettle the markets. And we've seen it. He's basically said he's going to put 25% on Canada, 25% on Mexico. He's going to hit Europe with probably 10%, and he's going to absolutely decimate people like China. But the reaction is going to be, a bit tough in terms of a potential trade war. So I reckon the S&P is going to drop Q1, but then recover later on. I actually think on the positive side, he's going to reach an agreement to have a ceasefire in Russia and Ukraine, which will probably send oil prices down and defense stocks slightly lower. And then I also think that the government, because it's basically rolled over on all the pay agreements with the unions, I actually think we're going to get some public sector strikes, etc. So that will have a bit of industrial action. And I think the Bank of England is going to cut interest rates faster than people suspect, simply because I think the economy and unemployment is going to rise a bit higher than people expect it. But if that happens, if we get lower interest rates, I think that will boost the home prices, which we're already seeing both, in the UK. And I think small caps will actually outperform because they operate at the front end of the yield curve. They borrow at spot rate from banks. So if that goes down, that's going to help them. And I think it will deliver a good, strong EPS growth, which will actually back up. It will actually produce a good year for small caps. And that is supported, as I've mentioned before, in sort of like valuations. And I'll just run through a bit of valuations. If you look at it on a PEG ratio, you've got basically AIM at about 0.6, and you've got NASDAQ at about 1.6. But there's so much value there that I think people will that will start moving the the sort of like the dial for small caps. I don't know if you've got any quick words on that one at all, Paul, in terms of macro.
Yes.
Well,
Yes, just a few. I just jotted down 4 points while you were talking. I think on the Trump thing, again, for me personally, I wouldn't want to predict anything on that. But my instinct is that these are negotiating tactics. You know, that's the way he works, isn't he? I've read a couple of his books, which the only thing I can remember from them is that he says, "Make sure you take out a prenup." He repeats that about 5 times in each book. So I think this is typical of his bullying tactics, and then deals will probably be done. But I don't know. On the other things, the only macro points I've got to add is that I'm quite bullish on the outlook for the consumer, because they're now getting substantially positive rises in disposable income. Wages are rising at over 5%, inflation's 2.6% or whatever. So the disposable income squeeze, I think, is all set to reverse. And obviously you've got a big rise in minimum wage in April again, which we know does stimulate consumer demand. So I remember Next said that a year or two ago, that they saw an immediate uplift in May. So I'm actually a lot more, the GfK consumer confidence stats have actually been rising the last 2 months, not much, but a bit. So I think the outlook for the consumer is much, much better than the market seems to currently think. Maybe it'll take a bit of time for that to unfold in 2025. Also, I think businesses are adapting to the changes in NIC and minimum wage, and businesses quickly adapt to changing macros. So I'm actually a little bit more positive than most people are on the outlook for business as well. And I think inflation should come lower. One of my readers pointed out that there are some big one of the biggest reasons for the inflation still running a bit hot is because of big rental increases of about 9 or 10%. But apparently the latest numbers have already shown that's moderated down to about 2%. So that will feed through. So I'm a lot more positive than the general. Well, not positive, because GDP is flatlining, isn't it? We've got to be realistic about this. But I think there are reasons to expect we might see a pickup in GDP, as 70 billion of fresh government spending is coming in as well next year. So they're loosening up the spending, and that is stimulatory for the economy. So I'm a bit more positive than most people are.
Yeah, no, I think it sort of reminds me of a famous song, wasn't it? Ian Dury and the Blockheads, "Reasons to Be Cheerful," part 1, 2,
Yes.
3.
Yes.
I think it was. But no, I'm with you. I'm positive, and I think small caps have been so battered are going to perform. Now, what I'd also say is, again moving on to sort of the Trump 2.0 winners, etc. Now, what would be quite interesting if he does put tariffs up, then second-hand product values in the US are probably going to increase, because primary values are going to have higher, which will help. I know we've talked about it, auction tech and likes of eBay. So that's something to watch in terms of second-hand value, particularly for premium sort of like products, etc. Regionally balanced manufacturers could do really well. Those in the UK, things like Vitrex, MPAC and Avingtrans, who have manufacturing in all 3 major sort of like Asia, Europe and the States, particularly in the States, etc. MPAC and Avingtrans are pretty big. Cross-border software service companies aren't going to get hit at all, I don't think, because I think tariffs are going to be on product rather than services. And I think these guys will benefit from a stronger US economy. Likewise, Barclays has a big bank in the US, Lloyd's Insurers, not Lloyd's the bank, boosted by the America First policy, because I actually think America is going to struggle reducing its inflation, but I think the UK is going to come down. Export commodity volatility experts, your CMC Markets, IG Group, TP Cap, if we get a lot of volatility, that's obviously bread and butter to these guys. US transport internal are going to do well, and Traxys is actually a beneficiary of railroad stocks if they have to, basically if they get busier, because essentially they're manufacturing more locally. Reshoring and greater economic activity locally in the States will be good for a lot of manufacturers. Somero, obviously, it builds things. MPAC, Ashtead, we talked about those before. And then companies with pricing power, they should be fine. Deregulation should be good for banks, should be good for healthcare. Auto, that's basically full self-driving. That's the Tesla effect. Crypto's obviously gone wild. And then your hunting, we've all talked about that before, oil and gas and hunting permitting should do it. So I think those are typically the winners. The losers, on the other hand, in my view, are going to be cross-border marine air shipping companies, things like Clarkson and Braemar Shipping. If there's less money, if less material is going between continents, then these guys may some of the pricing may come off some of the freight. Exporters to the US, obviously, they're going to get hit. The Chinese boys are going to struggle, maybe even Apple. US retailers importing, that's your inflation side. And then some of the I own basically Pfizer. I think the vaccine makers, they've got this head of healthcare who's nailing vaccine makers. I don't know if you want to have any quick thoughts on sort of Trump winners and losers at all.
Well, to be honest, Paul, I mean, I think these are all very interesting points, but I've never been able to translate trying to anticipate macro trends into making money on individual shares, you know.
Yeah.
So I don't tend to do it. I just say, look, I don't know what's going to happen. If I can see an obvious threat, say, for example, you know, like the Chinese direct to consumer imports, for example, you know, that when I finally saw it rather belatedly, you know, I stayed away from Boohoo and Shoe Zone, for example. So if I see an obvious threat, yes, I'll take macro into account, but I haven't got any ability to predict, so I'm reluctant to do so. Yeah, I'm more a bottom-up stock picker because I can understand what's going on at individual companies, you know.
Okay, well, let's look at one of those companies. Let's look at Filtronic, which came out, well, I think it was a trading update this week. And they've obviously, they basically do these wireless communication devices that Elon Musk has decided to use for their low Earth orbit satellite constellation. The shares have done really strong. It's a lot of very smart investors got into this early. I missed it, unfortunately.
I missed it. Yeah.
What's your sort of latest on this one? Because it has, like Elon Musk, the shares have gone to the moon.
They have. Very good. Yeah, I covered this one in Monday's report, my small cap value reports, and I like it. I've gone green on this. I think I was late to the party, but I went green, I think, back, 30th of August originally. So I missed the really big move up, and I'm reluctant to buy any myself, having missed, you know, a four-bagger. I actually think I pointed out here in my article on Monday that it's another quite significant earnings upgrade, and that the earnings upgrades have gone up sevenfold since late 2023, and the share price has gone up, I think, fivefold. So you can easily justify this big rise. Now, the only really serious question here is, are these earnings sustainable? They've obviously developed some amazing product, which is now highly profitable, and it's got the Elon Musk stardust sprinkled over it because SpaceX has got warrants over 10% of the company. So they wouldn't have negotiated that, SpaceX wouldn't, unless they were very interested in this company. So I think Filtronic has got all the signs of being in a real sweet spot at the moment. The only problem is, it's done this before. If you look back at the long history of this company, going back 20 years, it's had sporadic multi-bagging moments, and then the competition erodes them and they go all the way back down again. So we've just got to hope that's not going to... Now, I'm not expressing any opinion on that because I don't know. I don't know enough about it. I think the Harwood boys and the Rockwood guys are all over this, aren't they? So I think it's very interesting. It's on about 19 times, which is pretty reasonable. It has a history of, it's pulled forward some orders, the customer has. So some people are saying, does that mean that could then lead to a drop-off in next year's forecasts? But I don't know. My feeling on it is something special is going on here. So I'm positive on it, but I don't know what the future holds. How about you? What's your view, Paul?
Yeah, I'm with you. I mean, I've followed this one for like 20 years, and frankly, it's done nothing until the last 18 and has found a solution for its sort of technology. And most of the value, it's got a market cap of 170 million at the moment, of which I would say 150 million of that is associated with one customer and one person, Elon Musk and SpaceX.
Very good point.
So it's the valuation is even more concentrated than the actual customer revenues. And on that basis, if anything happened to the contract, you know, you've got to take that one person, sort of like one company risk associated. But having said that, on the bullish side, 170 million for a company that frankly is, you know, dealing with... Can you believe that? Sorry about it. Hang on, let me get rid of this. I don't believe it's my boss, and he's ringing me right in the middle of a podcast. Thank you, Martin. I've just turned you off. Anyway, but yeah, I would say that big, there's a big concentration of sort of one customer. Yes. So, you've just got to put that into perspective. But I would say 170 million market cap, if it can continue with that relationship for long term with SpaceX, then there's no reason why this can't be a billion, because this is going to be an enormous potential opportunity in low Earth orbit space. So yeah, it's up to lots of upside risk, but you just got to accept there's also a lot of one customer and one product type risk.
Yeah, all very good points. I agree with all of that, Paul. Yeah.
Okay, good. Let's talk about another winner that's done really well, which is Tristel, that basically does decontamination sort of products, wipes and foams for hospitals to kill off things like MRSA. And the shares have done brilliantly over sort of last 15, 20 years. What do you think of this one?
Well, this was reporting on the same day, actually. So it's in Monday, 16th of December's report that I wrote it up. Now, I'm like a stuck record on Tristel. I basically, I've followed it for many, many years. And I always say, yeah, it's a nice company, but the shares are too expensive. And but this time, this was a day where I actually moved up from amber green to green in my traffic light system, because I'm actually happy with the valuation for once. And one of my readers, David, I think it was, said, "Oh, Paul, you always bellyache about the valuation, but I need to explain to you why it's worth the valuation." I said, "David, I've just gone up to green and said I'm happy with the valuation." And he said, so you did. So that was quite a funny exchange. But so anyway, it was a trading update. And basically, what have they said? The only downside on it was they've said the US market that they've only recently entered. They said that's going a bit slower than expected. They're saying it's taking time to train up the salespeople with their partner. So I think that took a little bit of the fizz off the share price on the day. But then they said Germany is doing better than expected, and overall the business is, they've said it's another record first half, and they, quote, expect to hit, if not exceed, its 3-year target, and we continue to trade in line with expectations. So I don't really care if one country's a little bit up and one's a little bit down. As long as the overall is in line, then that's fine. And I've decided, I crunched the numbers and decided the valuation is reasonable. It's not cheap, but I think you're getting a reasonable valuation. PE is about 20, and it's got a very good long-term track record of growing earnings, and you're getting a 4% dividend yield, because Tristel is low capital light model with cash on the balance sheet, so it's got good dividend, and so it just basically generates cash and pays it out mostly in divvies. So it's unusual to find a growth company that also gives you a decent dividend yield. So yeah, I have to say I like it at this price. I think it was about £3.80. I don't know do you know what the latest price is, Paul? Oh, 3.89.
Yeah, exactly. Yeah, I had 3.90. Yeah. No, I mean, it's an excellent business. Lots of IPR there. One thing I would, if I was an investor in it, is have a look at when some of the patent expires on some of their technology.
Oh, that's a good point.
I think the first one finishes in 2028. So it's about 4 years' time. But that's the very first one, and they may have been out of date anyway in terms of it's been superseded by newer technology, etc.
Yes,
because
I was going to say. Yeah, quite often with these patents, they keep putting in more, don't they? So they have a sort of continuously rolling. But that's a great point. I hadn't even thought of that.
You can't patent the chlorine dioxide technology, the cleaning technology. You can only patent the design that uses it, and then effectively merges the chlorine with the dioxide to then use it for instantaneous cleaning for sort of small medical instruments, I think.
Yeah, I went to a webinar, this must have been 10 or 15 years ago, that Equity Development arranged, and it was when they hosted them at that firm of solicitors that let them use the meeting room free, and Tristel presented when the shares were about £1, and they said exactly that. I remember it. The CEO said, look, the chemicals are kind of generic chemicals, but the packaging we've developed and how you mix them, how you activate it, that's their USP. So yeah, but great point about the patents. Yeah, I don't know the answers.
If anybody wants to ask Paul any questions, please put them in the chat box and I'll read them out. We've got one from Ben Sharman here, Paul. He's asking about your latest views on Sanderson Design. He says it's at 58p at the moment. Is it basically just, is it fabrics and stuff like that, soft furnishings, if I remember right?
Yeah, it prints, it owns the rights to a lot of famous brands like William Morris. It's got all these heritage brands. It's got quite a big portfolio of brands. It's got a factory where it prints wallpaper and prints fabric in the UK. But actually that side of the business is really struggling, and they're only actually making any money from licensing revenues. So I've called on Sanderson, but it's so cheap now. Market cap's only 43 million. It's got a lovely balance sheet. It's trading well below net tangible asset value. And somebody could buy it just to buy the brands, because if you think, they can earn 4-6 odd million a year in licensing the brands. So somebody could buy the whole company with a bid premium for about 50 or 60 million. So but it could be too small to be a target. It pays dividends as well. Scuttlebutt on Sanderson, I did hear from one of my readers actually, who said that their designs have gone a bit off the ball lately, but they've got some good growth in the US as well. They've developed a range of products for old Disney designs, for example. I think it's an interesting company, but it does seem to be struggling at the moment. And if you look at the earnings forecasts, they're just in a really downward trend, which makes you think, oh God, is it going to do another profit warning? So yeah, I've cooled a bit on it, but I don't know.
Personally, I've but no expertise at all in which soft furnishing designs are going to work and which aren't to a certain extent. And
me neither.
But the housing market overall is definitely going to improve on both sides of the Atlantic, so that may or not be a tailwind. But when it comes to their competitive positioning, for me, it's just impossible to understand. We've got one question. Pete McClellan's asking about Puretech, and he's asking me, but and it's basically a medical royalties company off the back of Bristol Myers Cobenfy, which is a schizophrenia drug, etc. I'm sorry, Pete, I don't really know anything about Puretech other than that, and I can't really comment. But I did have a quick look at it, and I thought it was cheap. But frankly, I couldn't really comment on whether it's something to really get your head around. It'd be special situations, sort of like that one.
God, very special. Have you seen the losses? Good.
Oh, is it? Okay.
Woo! 60, 50, 65 million. Those are per annum dollar losses. 3 million revenues. Christ on a bike. No, I wouldn't. But it's got masses of cash. Yes, I have looked at this. It's got $470 odd million cash pile. Yeah, this rings a bell, actually. No, I wouldn't have a clue on this one. No, so back to you.
Anyway, Pete says, thanks, Paul. That was good. So anything. It's a big question, actually. Big question, Paul. Have you been buying or selling any shares this last week or so? The last 10 days?
Yes, I awarded myself Muppet of the Week award because I overgeared my little SpreadX trading account. And then, of course, I've been absolutely walloped in the last week, and I became a sort of more or less force. I went to a margin call yesterday, and I had to trim a few positions. So I've chucked out Kooth, which was just a tiny little position for a small loss. I've chucked out Engage XR, which again I lost about half my money on, but it was only a tiny position. And I top sliced 23% of my De La Rue, bang on the low point, and it's obviously bounced about 10% today. So I am officially Muppet of the Week.
Join the club there, Paul. I've struggled this whole last year, so hasn't been great for me. But I would I've actually just bought, because last time we spoke, I said that we'd sold some PayPal, almost PayPal shares. And
yes.
I redeployed those funds into a stock that is basically does student educational university software. It's a company called Tribal Group.
Oh yes, I know this one. Yeah,
and this basically it had an offer about 18 months ago from a rival, basically a trade buyer, Lucian from the States, at 74p, all cash offer, agreed by management, but was rejected by their biggest shareholder, who's also a trade player in university software, Zanzibar. They own 26. Anyway, what that means, and it basically fell down, and the shares, rather than 74p, which was the offer about 15 months ago, is now at 42p. What's interesting about it is two divisions. 80% of the sales, or nearly 80% of the sales, are software, and then the rest of it, 20%, is services. They're going to try and split off the services. It's things like training, teachers, benchmarking information, surveys, and stuff like that. And they'll get some money, and that'll help pay down the debt, etc. But if you actually look at the software business, it isn't growing a great deal at the moment. They've had because obviously universities have been struggling with budgets and have been delaying their spending. But 2/3 is recurring revenue. They have a £152 million order book. Essentially, they're profitable, cash generative. They only have about their high retention rate, and they've got upselling in terms of they increasing the share of the wallet. There's clearly, as I say, there's an unbundling opportunity. And their cloud-based SaaS platform basically does unlock a shed load of efficiencies for their clients. So what I suspect this will happen is that now that the government has just agreed increases in student fees from next year, and it's increasing over the next 5 years, I think some of the budgets will be unlocked because they can get great efficiencies. And this is like a trophy asset in UK student university systems, etc. And also it's big in Australasia as well, but hasn't really got anywhere else in the world. Bit in Asia. And I think what will happen, I've seen this movie play out before, because years and years ago I owned a company called Pilot Media.
Oh yeah, I did too.
Yeah, and well, we both did well then in that case, because it got fought over by two trade buyers who wanted to pick it up. And I think this is what will happen over the next 18 months. And at 42p, I personally think there's significant upside. It's only trading at about 11 times PE, 7 or 8 times EBITDA, and I get an 80p on a standalone basis valuation. That's no synergies, but I think there's massive synergies between a trade buyer and basically Tribal. And just give you an indication, when I come to value stocks, particularly software stocks, you've got to look at the value to the buyer, okay? And here you're going to get a massive disconnect. So takeover multiples will be like 3 or 4 times sales, okay? They'll be up here for what somebody, because the synergies are huge, whereas your PE ratio is only on about 11, is down here. So there's a massive disconnect or arbitrage between private and public valuations.
Yes.
And that is one of the, I just think this is a wait, the waiting game this one is. It's a matter of time before Lucian or alternatively Genzibar buy this one. And I think the catalyst for a potential interest will be when they spin off their education services. So I would highlight this. This is going into my top 20, by the way, Paul, the year end. So you've got to fight against this, okay? This is one of the top 20. Yes. So I'm pretty keen, but for me personally, it's difficult for me to buy a lot of shares. So I've only been able to get a half a position because there's no liquidity in it at the moment. But I'll just raise it to investors because I think it's quite an interesting stock. I don't know if you ever had a look at it.
Yeah, I followed this one for many, many years. I think those are all very good points. It did crop up on my radar again recently with that huge disconnect between the agreed bid, as you say, an agreed cash bid at 74p, and you can now buy at 42p. The only thing I would say is that it's so accident prone that over the years I've followed it, this Tribals just constantly manages to screw things up, often in quite spectacular fashion. They had, for example, a big Singapore contract that went disastrously wrong. But checking my notes here, I see in late May that was all settled. The legal dispute. So, and it was on, reasonably, it could have been a lot worse, basically. And I don't think it's actually that cash generative. I just push back on that. That might need checking, because I know it's got a history of paying very small or negligible dividends, which is not what happens when a business is cash generative. And also it's had balance sheet issues in the past when debt got a bit too high. But I think it's more or less on top of those issues now. So yeah, I think this actually looks potentially interesting. Personally, I wouldn't take more than a starter size position in it, given my nervousness about its propensity to seize failure from the jaws of victory.
No, you're exactly right. That Singapore contract was a disaster for them, and I haven't got to the bottom of. I've asked many a fund manager why that was screwed up
Exactly.
so badly, but I haven't been
Yeah.
able to get a firm answer. And I suspect it was simply to do with expectations management with Singapore University. They were expecting a gold-plated service of implementation, and frankly, they didn't pay for it, so they weren't going to get. They were going to get an implementation, but hey, we'll wait and see. But
Yeah.
I should say, I think this is right at the top of the takeover list. Once they unbundle that services business, I think this is right up there to be taken out myself, because
what we should do. Yeah, sorry, Paul. Finish your point. Yeah.
Yeah, no, so and I think that unbundling will be in the first 6 months, and then I think it'll become more attractive. And I actually believe over the last 15 months the business has significantly improved. So I would not be surprised actually a higher offer coming on the table as well.
Well, that would be great, wouldn't it? And I notice our friends at Harvard are in there as well. 10% they hold. Yeah, you could well be onto a winner with that, Paul. Maybe I should pick up a few myself. So yeah, interesting idea. Yeah, definitely.
It's not easy. Okay, let's move to the one you do like, or you got hold, is Gulf Marine Services, and these do self-propelled or elevating sort of like offshore platforms, basically service platforms in the Middle East largely, but also service, I think, some of the offshore wind increasingly in the North Sea. And as you rightly say, it's a deleveraging story. How are you viewing this one? They came out with a positive trading update this week.
They did. Positive trading update this week, and the shares went down. It's the most infuriating share I know. I was talking about this in today's report as well, where I just commented on your problem is this it's as with so many small caps at the moment, it's liquidity that's the problem on the shareholder register. You've just got shareholders who, for whether it's redemptions or for whatever reason, they're not exactly forced sellers, but they're persistent sellers. And CFOX, which was, I think at one point about a 25% shareholder, has caused mayhem at GMS. They did a secondary placing of a big lump of stock at 17p when the price was 20p. And since then, they've been giving away their shares. This is CFOX, their shares in GMS in specie to CFOX shareholders, some of which, of course, won't want them and will sell them. Anyway, we had another, I think yesterday, announcement saying that CFOX was dumped a load more of them onto their own shareholders. But the point I'm making is that the company just keeps putting out great news flow. There's nothing wrong whatsoever with the company. They've actually just this week raised guidance for 2025. So the company's trading its socks off. You could say maybe there's a threat from the low oil price, but you see they've then got an opportunity to shift some of these ships, as you alluded to, from the Middle East oil, where I think there's a lot of client concentration. Actually, they can shift them to the North Sea and use them as platforms to support offshore wind. So that is the thing that's different this time round with GMS. So I remain very bullish on the fundamentals, but it's just we're in this infuriating position where there's a constant drag on the share price from sellers. But for me, the fundamentals of the company matter way more than any short-term considerations about who happens to be selling the shares. So yeah, for me, it's just a permanent hold. And with each month that goes by, the debt is substantially reducing. So the upside gets bigger over time. So for that reason, I'm more than happy to hold. And there should be divvies coming in next year or possibly the year after as well. I think the forecast dividend yield could be about 6%. And it's got the capacity to pay far more than that. So I think this is one where the fundamentals are screaming to us, just be patient.
What's the sort of the beta or the volatility to the oil price, Paul? Do you know any ideas?
No idea.
Okay, because that would be something if I was okay. Because you're right. I mean, even though the shares have done well over the last 2 or 3 years, it's deleveraged. It still only trades on 4 times EBITDA, etc., which says to me, basically there's still potential upside, but people are also you've obviously got that selling pressure, a lot of technical stuff. But next year, who knows what will happen to the oil price? But if they do get a ceasefire between Russia and Ukraine, and also Trump demands that Europe buys US shale, then you might find a greater market share goes to the US in oil and gas.
Could be, yeah. As I say, in which case they can redeploy ships on offshore wind. That's what they haven't had in the past, and you know, it's just generating staggering cash flow. This thing, so it's all about debt reduction, and basically they only need to day rates to remain static and utilization to remain static for about 3 years, and the debt's all paid off, and basically they've got 3 years visibility in the order book. So it does seem to stack up, even if you factor in downside risks, I think.
Yeah, I mean, you know, they're dead cheap shares, aren't they? So a lot of bad news is already put in, and there isn't any bad news to be worried about. Okay, we've got one a question coming from Tweed Scott. He's asking about the Property Franchise Group. I don't know if it's an estate agent. Yes. Didn't it merge with Belvoir a few about a year ago or something?
That's right. Yeah, it was quite interesting. The management at the time of both companies said, look, Belvoir and Property Franchise Group, you're pretty much the same market cap, same activities, both well regarded, but your shares are too illiquid because they were about 120 million market cap. So apparently the institutions were begging them to just merge, which is precisely what they did, and that's now taken the market cap up to 250 million. Looking at the chart, I haven't written about this one recently. I don't think there's been any trading news recently, has there?
No, I don't think there is, but the shares have done really well, haven't they?
They've done really well. They've come off quite a bit, though. The recent peak was 485. They're now down to 392. So actually, that's given back quite a bit, hasn't it? Forward PE is 11.4. Dividend yield's nearly 5%. Maybe this could be an interesting. It's fundamentally, I think, a very good business, and it's mainly focused on lettings, so it doesn't depend on the peaks and troughs of the property transactions market, you know, because people are always needing to let properties. So it's kind of it's non-cyclical really, and I think that this might be a nice point to look at a fresh entry point, actually, given that the froth has come off the shares and you're getting nearly a 5% yield. So yeah, I think that was a good stock idea. So have a look at it. I think that's it's good, interesting opportunity.
Yeah, I would agree with you. I'd also add the latest property data coming out is that house prices are increasing at like 4% per annum and are set to do the same, according to Savills, for next year in the UK. If you're right about inflation in the UK and I'm right about interest rates in the UK, they're going to drop faster. That's going to be a huge lift for the property markets. And the other interesting data point that came out this week was that the amount of mortgage approvals year on year is up 20%.
Gosh, is it really?
It is, yeah, and that just shows you how much activity is going in. So people are now pushing the button on buying it, and this has got to be good on lettings, and it's got to be good on basically property transactions. So I'm with you. I think that's a good suggestion there, Tweed Scott. So
it is. Yeah.
Thanks for that. We've got Paul the Parrot. He's coming back again.
He's back every week, isn't he?
Yes, I know. CNC, which is I think they do sort of like specialized electronic components. Electronics, for largely defense. And they're building up a really good war chest of orders, if I remember rightly.
So Concurrent Technologies, isn't it?
Yeah,
if this rings a bell, I think I have looked at it recently. The last time I looked at it was on the 2nd of September, which was its H1 results, record PBT, full year outlook in line. I think it's okay. I know it's got quite a big following amongst private investors, which worries me a little bit. And I did have some reservations about the accounts when I've looked at it previously. So I'm not madly keen on this one, but it's okay. You know, nothing particularly wrong with it. Have you looked at it, Paul?
Yeah, I like it, but the problem with me is that when I like things, it's sort of like because they've got good sort of defensible moats, and they've got they're designed into long-term products, and then another company comes out with a profit warning, which is Solid State, which is in the same sort of area.
Do you know, I was just going to mention that. Yeah,
and that blows my confidence, and I think, do I really understand this industry?
Yeah, that's precisely my view, and we've seen this with quite a few of these businesses that rely on fairly large lumpy contracts. They can perform brilliantly, often for years, and then just bang, suddenly a customer cancels a huge order and you're right back to square one. I mean, solid state, peaked at £3. Here we are in June with a lovely multi-year positive track record. I thought it was a really good, solid company. And then the whole thing's been shattered in literally just 2 or 3 months. The MOD put some big orders on hold. That was at solid state. Now, I'm not saying anything like that is likely to happen at Concurrent, because I haven't got a clue. But I would just say I am generally avoiding these smaller contracting businesses of any kind, really, that are rather too concentrated on a few key customers, because you're a lamb to the slaughter if the order book suddenly dries up or whatever. Why take the risk?
Yeah, no, excellent point. And certainly I'd have a look at their exposure to that strategic defence review, which was the one which really sort of scuppered, wasn't it? It was solid state, because they pushed it 9 months, didn't they, into the summer of next year. And you can guarantee that's just going to get stuck in a cupboard and not really go anywhere, probably. But hey,
and you haven't got recurring revenues with these things to underpin them. So it's really dented. Recent events have dented my my whole appetite for taking risk on these small contracting businesses.
Yeah, and also actually the bigger picture is, I mentioned about if we do get a ceasefire in Ukraine and Russia next year, then that may take some of the froth off some of the defence companies. And you saw it through Chemring this week, which is a much bigger business that does flares, and it's got a very, very strong order book, but it said its margins were decreasing, which is what spooked the market, and that's why it went down. So I would say just be careful in the defence industry, because you tend to be paying premium prices for a long-term view that there's going to be strong growth, and that is there's lots of secular there's lots of secular trends that the NATO is going to have to increase its expend over overall from 2% to 2.5%. But there's just a few cracks at the moment in that defence thesis.
Yeah, I'm glad you mentioned Chemring, because I looked at that on Tuesday this week. It put out full year results for October 2024, which I regard moderately positively, which I categorize as amber stroke green. The things I particularly liked about now is the shares dropped 10% on the publication of the results, didn't they? Even though the headline, the PR headline at the top said robust performance, record order book, substantially increased demand. So I'm trying to remember what spooked it, because the shares dropped 10%. I think it
was the margins.
Was in the margins, right?
It was go forward margins. They're expecting to see, because of the strong order book and the increasing revenue, some drop through, and actually you saw margin compression at the EBIT level, not expansion, which was what scared people.
Yeah, but it's still confirmed that the outlook were in line with full year market expectations. So and the balance sheet is good. It's quite capital intensive. Chemring is. It's got 288 million of fixed assets. And it's got some big capex programs underway, some of which I think are government funded. Net debt is very modest. Now, on the cash flow statement, I notice it does generate good cash flows, but it spends about half of that on capex. And it did big buybacks as well, 41 million of buybacks, and quite good dividends. So just on purely a numbers-based desktop review, I thought it looked quite interesting.
Yeah, I think if you are interested in Chemring, you need to do a sum of the parts, because their rogue cyber security business is their crown jewel. And so if you did a sum of the parts on that and see what external people would pay for that type of business, then you might find it's more than double the actual share price. But
good grief! We should buy some.
Well, I mean, if a US buyer in cybersecurity comes knocking, there's three types of shares which have done really well this year. Nvidia and AI related, crypto, and cyber. And cyber, there's a massive disconnect between cyber valuations in the US and cyber valuations in the UK and Europe. So if they could do that, then there'd be a huge arbitrage. Okay, we've got a couple of questions from a couple of people. One of them is JKR. He's asking about Moneysupermarket.com, and he says they're near 2022 lows. Any reasons for? Because basically, obviously, it's a price comparison website.
Yeah, it is, isn't it? I haven't looked at this recently. Yeah, just over $1 billion market cap. Yes, it's been in quite a steep downtrend this year, hasn't it? Yeah, £1.91. I can't see any news recently. So So no, I'm afraid I'm not really sure. What are the stats like? Forward P 10.7 times. Gosh, look at the dividend yield, 6.75 times. No asset backing though. High ROCE numbers. I've never liked these price comparison sites. I just don't like the business model on them. So I haven't really got any insights on this, Paul. How about you? Other than that, the dividends look very attractive.
Well, my scuttlebutt analysis is my wife loves Moneysupermarket.com. It's all over like this, like the plague. So we get all our utilities. So it's still living and breathing. But I would say it's nothing to do with what the current business is, because it's super cheap. It's all about investor expectations about go forward. And if you get basically internet discovery replacing search, then potentially the likes of Gemini and Chat GPT, and I can't remember the one for Facebook, they could disintermediate this whole area.
How interesting.
That's the thesis. That's why a lot of these areas which have strong sort of online real estate, people are worried that actually they're going to get cut out eventually.
Well, that's very interesting. What a good point. Wouldn't that also be a threat to Rightmove?
Yes, in theory, yeah. But the thing is, you've got to have access to the data, whereas it's quite easy to get to scrape other people's price offerings. Whereas if you've got actually proprietary house images on your system and nobody else can get them, then that's tough. But if it isn't and it's accessible, Paul, you're spot on. Yeah, it is a potential. What they call it, a Trojan horse in there.
Yeah. So this AI business, I mean, it could change things in ways that we can't really anticipate, couldn't it? So
I know.
Yeah. Interesting.
Okay. We've got one from Dara Gillen. He's asking about Dialight, which I think does industrial LEDs for sort of like tough, rugged applications, things like into factories, and so anything that's high performance.
Yeah, serial underperformer, this one. There was a flurry of excitement over the summer over this. But I remember I was walking along Regent Canal in London on a boiling hot day and listening to one of your interviews. You're marvelous.
Okay.
Yeah, they're brilliant. I love them. The fund manager interviews are so interesting. Yeah. And one of the guy, I think it was the Odyssean guy, was talking about how, there was a chance they would win this big legal case, and they were sorting out their production factories. But unfortunately, it wasn't to be, and they lost the legal case. And the more recent updates from Dialight have actually been very worrying. One of them, I think I'm right in saying, it had to issue a going concern material uncertainty warning in a recent update, because it hasn't got the money to pay the 20-odd million that it needs to pay to the party that won the legal action against it. So I think this one's actually now quite high risk. So I'm steering well clear personally. But any view from you, Paul?
Yeah, I mean, it isn't the kind of thing I'd particularly go for. I don't really know what IPR these guys have got. I mean, I mean, obviously Stuart Whittlesome, the chap who you spoke to, does, and can understand why it's got but I'd have to really look at what the USPs are. I mean, what makes any difference for? I mean, do they actually manufacture and design their own lighting technology, or do they get it from?
Yeah, I think so. It's as you say, it's LED lighting for industrial type applications, isn't it? I'm told it's things like, when you drive past these roadworks where they're doing something at night with these super bright lights. I think it's things like that. So I'm not quite sure what competitive advantage, if any, they've got.
Yeah.
And yeah, this was it. Here we are on 25th of November. Dialight said that they might have to do a placing or request a payment plan with Sanmina, which is the creditor that they owe all this money to, which makes you think, well, why would Sanmina offer them a payment plan? I mean, they might do if there were heavy interest charges applied to it. If if a listed company owes you 20 million, you just tell them cough up, don't you, and do a placing. Yeah. We don't care. Yeah. Do whatever you have to do to raise the money. So I think until the funding position is clarified with Dialight, I wouldn't go near it personally, and I don't think I'd be interested in going near it anyway. And I think that didn't the CFO resign?
Yeah, I can't remember.
It looks a can of worms to me. So yeah, I just don't want to take the risk. Why get involved?
Okay, so that one gets a thumbs down.
I'm
We've got
afraid
one from
so.
Trader Mark 72. He's asking about Knights Group Holding, which I think is a
Oh yes.
legal services business in the UK that's probably done pretty well of
Yeah,
late.
let me call up the thing. I haven't looked at it recently. Oh, it's drifted down a lot, but most things have, haven't they? Most small
Yeah,
caps have.
yeah, yeah. Look at my
One of these.
portfolio.
Yeah, I see it dropped some sort of major clanger in March 2022 when it absolutely plummeted, lost about 3/4 of its value, and it's never really regained it. So I'd have to look back and refresh my memory about what went wrong here. I'm not a fan of these listed professional services businesses, legal or accountancy, but the forward PE is only 4.2 times,
Yeah.
and you've got a
Why aren't you a fan of them, Paul? Probably for the
well,
same
because
reasons
they're people businesses, aren't they? So the people can, and I think you have that just innate conflict between people businesses and paying outside shareholders. I just don't think it works. These things are better off when they're partnerships, where the people, the rainmakers who generate all the fees, actually own the business. I think it's an uneasy fit having external shareholders, and so many of them seem to go wrong. That's the other thing, isn't it? So the talent can walk and set up in competition. So yeah. I mean, Knights looks, I have to say, it looks optically ridiculously cheap, doesn't it? Which usually means there's something wrong. But yeah, I look, a PE of 4.2 is enough to make me want to have a look at it. So yeah, maybe I need to look at that fresh. Have you? Is it one you've looked at, Paul?
No, I stay away from people services businesses for the same reasons that you do. But I would say I am more interested now simply because of the budget. It means that a lot of wealthy people are looking for tax structuring, for new legal arrangements, such they can
Yeah.
efficiently manage their wealth, maybe offshore or whether it's in another, in different assets, etc. So I do think these guys, as a service, as a sort of like a legal, tax, or financial services industry, I think they're all going to do pretty well actually the next 2 or 3 years, because a lot of people are going to need their services for specialist, really bespoke type information and advice.
Yes,
So,
that's a good point. Actually, while you were talking, I've just called up my notes. I haven't looked at it since early July when it put out April 2024 results. And I've commented here, I said in my report, that was when I was at Stockopedia, I've said the headline numbers look great, but the deeper I got into the detail, the less keen I became. In particular, cash flow doesn't look up to scratch. And for that reason, I dropped it from amber green to amber. I said here, there's nothing particularly bad. It's just not the great bargain that it initially looks. And that was when they were £1.45. I think it's a bit less than that now, isn't it? But I mean, everything has drifted down. So yeah, make sure when you research it. Yeah, it's down, it's dropped a lot. £1.45, then £1.3 now. So I think be careful and focus on cash flow when you're researching this.
yeah, wise words. Okay, well, we've got a question coming in from Lemon Physically. He's asking about Johnson Matthey, which I think is basically the poster child of all things catalytic converter. Traditionally sold into it does platinum catalytic converters, which go into lots of sort of diesel generators, power generators, but also I think into trucks. And it was obviously into cars, but now we're moving to electric. There's worries that obviously it's going to be less useful. But I don't know if you've ever had a look at this one at all. The
Only
shares
once, I think.
yeah, the shares have been nailed, haven't they? Just recently, they've just dropped off. Actually, I just saw just from £15 down to just less than 13. So I don't know what that is. It could be something. I tell you what, it could be something to do with, Trump or something like that.
Yeah,
Trade
you're right.
wars.
I did mention this in passing. I mean, it's too big normally for me, 2.2 billion. But the reason it's coming back to me, the reason I did write up a short section on this, it's the first company I can remember that's actually RNS'd a profit warning due to the threat from tariffs that you've just mentioned. And here we are. I can see on the news wire the largest shareholder is calling for a strategic review and a board reshuffle. So it looks like there's something. Standard Investment seems to be trying to shake things up there. But yeah, it was definitely a profit warning, the way they said tariffs they think are now going to reduce their profits and their demand for the products. But it's not a company I know anything about.
Yeah. Okay, good. We got one from G7 Wins. He's asking about Funding Circle, which is another star performer from the Rockwell Strategic stable, I think, and another one
Yes.
I've missed. But it basically does peer-to-peer lending, and it acts as a platform to connect institutions with companies, give them sort of like, you know, funding to disintermediate the banks. I don't know if you had a quick look at this one at all recently.
Yeah, I did. I actually sold these yesterday just because, as part of sorting my margin call. So
Oh,
I
okay.
was, yeah, I would have liked to have kept it, but I was just a forced seller yesterday through my own stupidity from overgearing. But I do like it, but obviously not as much as the other things that stayed in my account. Yeah, it's been, it was a real find, you know, for the people who spotted this early in the spring.
Yeah.
When you could buy it as low as 25p, and it's 5-bagged even after softness. The story was that it was basically trading below its own net cash. I think it sold off its US business, which was a drag on profit, and it's got it's one of these things where it had, you know, loss-making divisions masking the really good performance of other parts of the business. So that's why it's massively re-rated. I think I'm right in saying the net cash might still be about half the market cap, and it's got some interesting stuff going on. So yeah, I do still like it, but for me personally, I had to ditch it around break even or a small loss. So yeah, but I'm not fully up to speed on it. I need to have a fresh look at that one actually. So what's your is it one you've looked at, Paul?
To be honest, it's a bit of a sort of like a raw nerve. Quite a lot of
Yes.
these, I fall into this trap, and I don't know whether you do, Paul. Okay, I look at so many stocks over such long periods,
Yeah.
and companies that just keep going down and having tough performances. And I'd put that into Filtronic. I'd have, you know, sort of like before this last year or so. I'd also put it to CMC Markets, and I'd put it to Funding Circle and people and Rolls Royce. And I've put it, and I've looked at it so many times, and I've basically pigeonholed it wrongly into effectively a company that just isn't going to ever get out of its funk. It's just going to carry on
Yes.
going down, and it's in a poor situation. It's got albatrosses everywhere, and so consequently, when you start seeing green shoots, I stereotype the company wrongly that it can't possibly get out, and therefore, like this and like the other ones, I'm far too late to the party. I'm sort of a skeptic as it all goes up, thinking, oh, it's going to do this again, it's going to do that again. And I think your expression, which is you need to take a fresh look, a fresh pair of eyes at it, is what I failed to do. And I don't know whether you ever do that, but I know other investors as well. Sometimes you can just pigeonhole things wrongly into a bucket.
Definitely right. We're all guilty of that. The other thing is, I mean, there's 1,300, 1,400 odd stocks. You can't monitor everything. So what I do is I have just a watch list of about 100 stocks, which I put on there, which are the things I actually own or that I've looked at and thought look really good and I maybe should own them. So that means I'm only really closely monitoring 100 stocks out of 13 or 1,400. So I do miss a lot of things. And this is why I initially started my daily reporting. I wanted to look at everything basically, and I actively try to shake off the prejudging of things. So when I read an RNS, I mentally just try and take away my my preconceptions, look at it with fresh eyes. And yes, I think that's a useful phrase and a useful thing to do, but I didn't realize why Funding Circle was shooting up in the spring, and I didn't hear it. Often takes someone else to articulate the bull case for you to actually understand why it's going up, because it's often not obvious, and that was the case there. And by the time I think I switched onto it on the here we are at £1.14 a share. So that was on 5th of September. So I was blissfully unaware of this marvelous multi-bagging share until it got to blooming September. So I mean, that's no bloody good, is it? So I need a better sort of alert type system. This is often actually where I rely on the community to actually flag things up to me. You know, we need readers saying, Paul, have a little, either of us, have a look at this. You know, there's a nice situation here emerging. And if they explain why, that's how I found Alimask when that was about £2. It was the readers saying, oh, something really good's going on here, Paul, you should look at that, because I just ignored it. Like you say, I just thought, oh, that's no good. Don't even bother looking at it. But I looked at it and I bought some, and it shot up to about £3 and it stayed there. So it just shows, I think it's a team sport. We can all help each other by flagging up the best opportunities. And of course, it's in people's interest to do that because they've already taken their own position. And then, so shouting about the rooftops from it to other investors helps other investors, and it helps you, doesn't it? As long as you don't ramp. I mean, I can't stand rampers. You know, you want to see people giving you a balanced view of it, don't you?
Yeah, no, I mean, we're all relying on you, Paul, because you're our eyes and ears to the market. So just keep doing what you're doing, okay? We haven't got the time to do it or the energy. Just keep at it. Okay, we got a question coming in from RP Invest. He's asking about Hill and Smith, which is the effectively galvanized steel producer for things like crash barriers, but also quite specific bespoke industrial applications. It's doing gangbuster out in the States at the moment. And looking ahead, I would say it's probably going to continue. Actually, good margins in this business as well, which you wouldn't have thought it possibly could do.
Yeah, the historical track record, it's not a business I know very well at all. 1.5 billion, yeah, so it's a bit bigger than I usually look at. The broker forecasts I see are just in an almost going up nearly every month. Really nice trend in broker forecasts. What's the balance sheet? Yeah, 6 times net tangible asset value. Forward P's 15. This looks quite good. Do we know why there's been a sharp sell-off in December? It's dropped from £21 a share to about £18.70 a share. Do we know what's triggered that?
It looks like noise to me. It doesn't look like anything, being honest. If you look at it on a longer term, it's just noise. The signal's up, isn't it? It's basically been, it's the secular tailwinds is US infrastructure needs trillions of dollars. You just look at Ashtead and you look at, I'll tell you what, actually, yeah, Ashtead had they just basically said recently, didn't they? That
slight softness in demand.
So I bet there's a read across, actually. I bet that's probably answers the question.
Yeah, but you're probably right. That stacks up. Here we are. Hill and Smith put out an inline update. That was on 20th of November. So that's probably sufficiently close to the... what's the year? Oh, I might have covered this. This rings a bell, actually. Trouble is, as I look at 700 companies, Paul, half the market, I can't, literally, I've forgotten what I've written about 5 minutes after I've written the article. My brain just jettisons information. Yeah.
You'll need a team of Daves. Okay, we've got a question coming from Sanjay. He's asking about Intercede, which I know has been a real winner for you, haven't you? You've done really well out of this.
Yeah.
It's basically, there's digital security, sort of like two-factor authentication software to perhaps the bluest of blue chip customers in the world, which is US MOD.
Yeah, that's right. No, it's mainly based in the US. Customer list to die for. I'm a long-term bull on this. It's come off a fair bit from the recent peak, £2 down to £1.63. But I mean, what hasn't in small cap land? Everything's the selling is not related to fundamentals at all at the moment. Generally, I think it's just fear and liquidity-driven selling. No, I really like Intercede. It was on my 2024 top lists, and it doubled, but it's come off a bit now. It's still up about 60-odd%. I think I'm going to put this, just to give you a sneak preview, Paul. I know you've been fishing for ideas on this. I think
I'm fishing as fast as I can here. Yeah, go on, go for it.
Just a sneak preview. I think I'm going to probably roll it over into my 2025 top 20 as well. Good. It doesn't look obviously cheap. It actually looks quite expensive on a PE basis, but they're selling. It's all about winning big contracts, and it's lumpy. It's not the finished article yet, but the upside case is that this thing could land some more big contracts, and but it's underpinned by the recurring revenues from the existing contracts. So I like that. It's not one of these awful cash burn fundraising things. It's home and dry in terms of the recurring revenue covers the overheads, I think. And then every now and again, bang, they just land a huge multi-million-dollar contract that drops straight through to the bottom line, which is precisely what happened last year, actually. And I think people have been hoping that it would put out an ahead of expectations update. This is the one where I interviewed the CEO about a month ago. So have a look on my Substack for that audio interview. He's very, very good. Really is excellent, the CEO there.
Yeah, I would. The only thing I would add would be, don't get worried about valuation on these. The takeover multiples for this type of software are just off the charts, and therefore PE ratio is actually irrelevant in my view, because there's such a huge arbitrage between public and private. If this one gets bought out, it'll be at a huge number. I have the same one with one of my softwares I've owned for 10 years, which is Alico. PE looks toppy, but actually it's still only trading at it's trading at like a third of what private equity or a trade buyer would pay. And you just look at it, and I just think Intercede's exactly the same. It's a high margin software business with brilliant customers. And if somebody wants to put a number in and take it, then they're going to put a big figure on it, because they can use, just all drops to the bottom line, and they can use it across the world.
Yeah, I think that's nailed it. I mean, although the value investor in me fights against this stuff, you've got to look at what's actually happening in the real world, haven't you?
Yeah,
and if private buyers and private equity are really prepared to put big multiples on these sorts of recurring revenue software businesses, then, we shouldn't be fixated with PE when the bids are coming in on a completely different valuation basis. And I might have mentioned this before, but what I thought was very surprising was when Christopher Mills, I think, did a very good interview with you. It's funny, I can always remember where I was. I was walking through a village in Gozo at the time when we were listening to that on a lovely hot day. And, he didn't once mention PE, and none of the Harvard boys do. Yeah. They always talk EBITDA multiples. So I think sort of dinosaurs like me need to actually release our grip on PE and actually think about other valuation multiples as well, as which we've discussed before, haven't we?
Yeah. I mean, the reason why they do in particular is they take big chunks of companies, smaller businesses, up to 29 or 25%, etc.
Yeah.
With the go in there heavy and go onto the board, and their idea, their exit is not selling in the market. Their exit is basically takeover, and therefore the multiple that they put on what they think is going to be the final valuation for the business is where they believe somebody, a trade buyer usually, or it could be a finance buyer, what would they normally pay for it? And that's how that's why they always do EBITDA or sales multiples with high gross margin businesses.
Yeah, and they're brilliantly successful at it, aren't they?
Yeah,
that's the thing. So I look at what the winners are doing and sort of try and take a leaf out of their book, and that method may not work forever, but whatever's working at the moment, I think we need to take a leaf out. Just watch what the consistent winners are doing and copy it, really.
Yeah, no, exactly. The copy is the definite word there. But I recommend any investors, if they you want to come to do your portfolio sort of picks for 2025, download what the Rockwood and what the Harwood and these guys, the investors that you believe are very good, download what they're actually owning and have a look at those companies, because they can come up with some great ideas.
They can. And I mean, I flagged up Rockwood's recent results to my readers because they gave chapter and verse in I think it was the interim figures. They gave chapter and verse on each holding. So we can then, we don't need to buy their fund. We can just look at what they're in and cherry pick the ones we want. And the beauty is we can get out. The problem they've got is because everyone makes mistakes, when they make mistakes, they're stuck. So I think we've got a big advantage, actually.
Yeah, possibly. Okay, we can't go on the board, remember.
That's true.
Okay,
that's true.
Okay, we've got a question, and this might be another one for your top 20 for 2025. Dave H is doing a follow-up. He says, any news on Beeks Financial, which is the cloud business?
It is Beeks Financial Cloud. Yes, this is one of my top 3 personal holdings, I should declare. I was hoping for an AGM statement this week, but then I saw the result of AGM statement, and it just gave the voting. So they didn't issue one, but I haven't actually checked to see if they did an AGM statement last year. I'm not sure. The top evaluation again on Beeks, no doubt about that. But the business is a really, really seriously good compound growth story that's broken through into proper profits and positive cash flow now, owner managed. They've obviously won the NASDAQ contract, which still hasn't been publicly announced, but you can find it on the internet. And they also have 2 imminent contract wins, which they've stated publicly, from other secondary stock exchanges. So it's rapidly becoming the specialist in cloud computing for services for stock exchange stock exchanges globally, and management are really upbeat about the smaller ones, because what they're saying is there's actually a bigger opportunity, because anyone who wants to trade through NASDAQ can do. So I don't think the NASDAQ contract is necessarily going to be that big, but we don't know because it's not in the forecasts. That's the key thing. So, or, you know, your forward P is 32 times, but that doesn't factor in profits from the NASDAQ, which could be, I mean, I don't know, it could be very, very large. It's not going to be small, is it, the profits from that contract? And Johannesburg has worked really, really well, and the client doubled up the number of servers recently. So I think it's got everything going for it, Beeks. So I'm quietly excited about that one.
Yeah, no, I would agree. I think it's got some fantastic contracts, and it'd be interesting to see what somebody else, how they'd value the business in terms of you know, private purchase. We've got JC's asking for your latest thoughts on hVIVO, which has been a bit soft of late. They basically challenge trials, etc. They looked as though they've been hit a bit by the Trump selection for the head of healthcare, who's nailed vaccine makers, which I mentioned at the start of it. But to me, this looks like a buying opportunity, but I don't know what do you think?
Yeah, I agree. This one I reported on Tuesday, the 10th of December. We had a good reader discussion with it. This is on my Substack, obviously. And yeah, I think it dropped suddenly from 30p down to about 18. I think it bounced to about 2021. I think it could be a buying opportunity as well. So I'm positive on this. Don't hold any personally, but I'm considering it. I think one of the readers flagged up that the part of the reason for the sharp pullback could have been that some American competitors said that demand had softened. So it was, I think, a bit of a sell-off in sympathy with, and somebody else flagged up that I think H1 was stronger than what H2 is anticipated to be. So you've got to accept the fact that there's large lumpy contracts, bit of unpredictability there, but it said its margins are anticipated to be at the upper end of market expectations. hVIVO did. So yeah, I think it may not be forward PE is only 13 times, which does seem cheap, and it's got cash on the balance sheet because it gets paid up front, but quite a big chunk of that cash is actually the company's own cash now. So I think it's very good, and this I think is more likely to be a buying opportunity than something going seriously wrong.
Yeah, I would agree. I would do a bit of analysis actually, and just see who's trying to work out who's selling. Why are they selling?
Okay.
Because it looks weird. It looks like a bit like, I mean, I know it's got a much stronger balance sheet, but it looks a bit like technical selling from, you know, Gulf Marine Services, and therefore it's just artificially it's an opportunity. But that's how I would.
Have you or any of the number? Are you saying that any of the 3%? The 3% shareholders. Oh, here we are. Octopus. This is Stockopedia do a very good table where they show the changes in the over 3%. Yeah, Octopus sold 13.7 million shares in mid-November. JP Morgan sold a big chunk of shares in. Oh, that was back in March, so that's not recent. So it looks maybe Octopus selling. I think are they seeing outflows, Octopus? I can't remember much about. I think they might be.
It depends on which fund they are. If they
yeah, good point. This is in the UK Micro Cap Growth Fund. So yeah, it could be a buying opportunity, couldn't it?
Yes, it could be. No, it looks good to me. Okay, we've got Rockchild is asking for Watkin Jones, which is the old student accommodation maker, but is also going to build to rent. It had overstretched itself and has got a cladding provision. I think it's got to work through as well.
That's right. But funny enough, I mentioned this in today's podcast. Randomly. There was no news from it, but it just came up on one of my screens that I hadn't. It's down to 18p.
Yeah, I know. That just looks ridiculous, doesn't it?
It is. I mean, you hit the nail on the head with the cladding remediation issue. It's got a large provision in the balance sheet that looks like it's going to burn up their cash pile, and they have a funding question mark over them. Watkin Jones said that it's going to need to look at alternative funding methods. So, of course, worst thing you can possibly say, and then nothing happens because everyone just sells off expecting a placing, don't they? So I'm not brave enough to get involved here, I have to say. You're either going to get wiped out and lose your money, or you could have a multi-bagger here. I don't want to take the risk. I don't want to risk any 100% losses. So I honestly don't know on this one.
You don't fancy going short on it, or margin call it? Go long margin.
I'm useless at shorting, and I definitely wouldn't go. I definitely wouldn't go on leverage positions on things that are risky. What I'm doing with the leveraged account is I'm taking gearing on safe things.
Yeah.
Do you see what I mean? Because I'm adding a bit of risk to a position that's the theory. Doesn't always work, of course.
Yeah. Okay, good. We've got a quick question. He's a guy was asking me, Ben Sharma was asking me about private equity trusts have picked up. I'm sorry, Ben, I don't know anything about private equity trusts. I don't know whether you do at all, Paul. No,
nothing.
No, I'm sorry about that. Okay, good. We've got Omar Salamat. He's asking about Spectra, which I think is one of your winners again, which does sort of like authentication for sort of like note manufacturing and stuff like that.
Yeah, it's got about 5 different banknote cleaning. I won't go into all of it, but
yes,
people can look it up. But it's got about 5 different projects, all of which are working really, really well. Absolutely incredible business. There's a lot of investor interest in this. It's founder, owner managed, and it's got basically a team of about 20 boffins within the group who just keep coming up with all these great ideas and making them all work commercially. It's incredible, unique, really. I can't think of any other microcap that's done this. I was late to the party on this. It's been a serious multi-bagger. It was about 20p back in 2015. It's now 10 bagged, 12 bagged. You get lovely divvies, 4.4% dividend yield. It's got an avalanche of cash coming in this year from a banknote. A central bank censors contract, which is highly lucrative, but it only happens every 3 years or so. And 2025 is one of the bonanza years for that. So you can see the forward PE is only 6.8, but that is based on, elevated profits due to this big contract. I would just urge people to have a look at it. I think it's very, very good. Great track record. It's not blue sky. The blue sky stuff's in for free. And some of it looks very, very good. So I like Spectra a lot. Have you checked out this one?
Yeah, no, I like it, but unfortunately, it's not liquid enough for me to a certain extent. But I think it's a good stock. Okay, what about Zotefoams came out with some pretty big news, which was sort of like signaled, wasn't it? Which does basically industrial foams, but had its resource was it?
Resource,
decided to mothball it, but it hasn't been great for the share.
No, which wasn't a surprise. Somebody attacked me on the bulletin boards over this. They were talking nonsense because I flagged up in my report on the 4th of November. I prominently flagged up the fact that the company's tone on the resource development project had completely changed. It's suddenly because the CEO changed, and once he got his feet, the previous CEO was super bullish in all his messaging on resource. The new guy gets his feet under the table and a few months later puts out a really downbeat assessment of it on the 4th of November. And the broker, which again I flagged in my report on the day, on the 4th of November, the broker said the company is not going to continue funding resource after beyond the end of 2024. So for people who are paying attention, this was flagged prominently by the company and by me. So but still, when they announced, I think some of us were obviously hoping that they'd find a partner to joint venture with, but it didn't happen. And you can look at the share price in the last 2 months, and when the news actually came out, it barely moved. It only dropped about 6% on the day, and I think it's bounced back. So £3 a share. This Zotefoams now is very cheap. Forward PE of 10. The core business is trading great. It's got very strong tangible asset backing from its freeholds. Its trouble is now it's not exciting. We were all hoping with that multi-bagger potential in for resource. We were all dreaming of hitting the jackpot. So now it's just a bit more boring. It's just a decent quality, nice business on a PE of 10, which is quite attractive, but you're not going to probably double or triple your money on it, which was the thing I was hoping for with resource. But I'm certainly not selling at £3. That's a ludicrously low price. So I accept I paid about £4.80 for it, so I got it wrong, overpaid. But, you know, I went into it with my eyes open that the resource thing was like a free upside, as I thought, but it's turned out that it wasn't free.
Yeah.
Yeah, it happens. You know, you weigh up risk reward and you make your decision. Sometimes it works, sometimes it doesn't. So, but apologies to anyone who followed. I know I don't need to apologize, but I always feel I ought to if people
No,
followed
it's
me
not
in.
your.
Even,
It's not
what?
your ownership. It's not your ownership, Paul. Absolutely not. And the
No,
reason
that's
is, the
right.
reason
I mean,
is,
if I deceived people in any way or ramped it, fair enough. This guy accused me of ramping. Well, he's a liar. I didn't ramp anything.
yeah.
I told the positives and the negatives and gave a balanced view.
Yeah. And I would like to highlight to everybody who's listening to this, yeah, even the best investors, Christopher Mills, Richard
Yes.
Staveley, anybody you choose, they'll only have a hit rate of 60%. 40% will
Yes.
go wrong, okay? So
Yes.
what anybody who's hearing what I'm saying and what Paul's is saying, just put that into the context that
Great
4
point.
out of 10 of our highlights are going to go wrong, but overall,
Yeah.
if you with the other 6 over 25 years, you'll do well, okay? But frankly,
Yes.
if you're gonna invest, you're gonna be wrong a lot of the time, and you've got to accept that. Okay,
That's a
another
great
one.
reminder. Yeah, I echo that absolutely.
Yeah, one company which did get a kick in, which is a favourite, it's ShoeZone,
Oh yes,
this was
yes,
a nasty trading update after the budget,
yeah.
and I haven't really got to the bottom of why it had such a. It said it was because of the basically consumer spending, but why is this consumer spending suddenly turned off for their shoes rather than anybody else's?
Yeah, this was really poor. This was
Mm,
Wednesday this week, 18th of December. I gave it a real roasting in my
yeah.
daily report because here the budget was 30th of or 31st of October. Well, here
Mm,
we are 6, 7 weeks later, and Shoezone's suddenly realised that it's going to have to pay its staff more than expected from April. You know, it's just pathetic. They've
mm,
halved their guidance from profit from 10 million to 5 million. Funnily enough, I was listening to your interview with Richard Crowe today on the way back
mm,
from Tortilla for my lunch, and Richard flagged, as I'm sure you recall, that apparently the two brothers who own 50% of it and run the company have fallen out. So I didn't know that. So it'd be interesting to know what's happened there. But look, I mean, it's incredibly cheap on fundamentals now. Even on the revised numbers, the EBITDA, the EV to EBITDA is 3.1 times. So I
mm,
flagged that and said, look, this thing's really cheap. But the trouble is they can't forecast and they don't seem to know how their business is performing. And I've been saying for a long time, actually, that I think the Chinese direct-to-consumer people are a threat because they only need to take 2, 3, 4, 5% of Shoezone's sales, and that wipes out their profits because of the operational gearing. And again, Richard echoed that in his interview with you, I think. So
mm,
I've just had to put Shoezone into the don't know tray. Yes, it looks
yeah.
very cheap. It's not under any financial threat. The balance sheet's fine. But it's having to close some loss-making stores again. So I don't know. I don't know from me, Amber. So what's
Yeah.
your view, Paul?
Well, I still sort of scratch my head in terms of why their businesses, why their shoe stores are getting hit so badly compared to anybody else's. But I would say their balance sheet could be deceptively strong in the given that if they've got to close some stores and if those loss-making stores have long rental periods,
They
tenancy
don't.
agreements,
They
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 don't.
don't.
Okay,
No, with Shoezone, it's always kept the leases really short.
okay,
I haven't
fine.
looked at the latest figures, but it used to be the average lease length of about 2 years.
Okay,
So yeah, it's a
yeah,
good point, but I think
yeah.
they've covered it.
Okay. Another one, which is a bit of a darling that came out with a bit of a bomb, well, hasn't done so well, is Capita, which is this outsourcing
Oh
business.
yeah,
And it's worth
yeah.
highlighting this because it looks as though their turnaround is happening, but they're shedding some unprofitable business. And because they're
Mm.
shedding their unprofitable business, they're losing a lot of working capital, upfront payments. And they had 120 million pound, I think, a cash hit for this year, even though they're profitable, and that spooked the markets. I
It
think,
did. You're
anyway.
right. Yeah, you're right. That's refreshed my memory. Again, the Harvard boys have been talking about the turnaround here, and it made a big disposal that cleared all its net debt,
Yeah.
and it went up from 14p to 22p, but it's come all the
Mm.
way back down again.
Yeah.
for the reasons you said. The most recent update said there's going to be a massive, I think it was 140 million cash outflow, free cash. Now, funnily enough, I did spot this, and when I checked it after hearing the Harwood guys raving about it, because it's a margin expansion story, isn't it? They want to get the operating margins back to 5-6%, which if they do that, you know, that would be remarkable. But I did flag up that although bank debt was cleared from the software business sale, it still has a really ropey balance sheet with negative net tangible asset value, and it lives off customer upfront cash payments. So, as you say, I hadn't thought of this actually, but as they're letting lower margin business go, that negative net working capital actually unwinds, meaning they have a cash outflow. So I need to have a proper look at the numbers fresh, but I'm certainly tempted because market cap's what? 242 million for a huge group, which if it gets anywhere near to the historical operating margin, it could be a nice one. No divvies, of course, because it's been a painfully long-winded, slow restructuring here at Capita, hasn't it? And no doubt they'll also take a big hit from the NI thing from April as well, because I think it's a staff-intensive business. Maybe opportunities from automating things with AI. Don't know.
Yeah, I would say you need to look at this as the fine-tooth comb. It's a special situation.
Yes.
Right, do a breakup, some of the parts, and see where you get to. But I personally don't like contracting business where there's negative working capital. And if you've got to come out of loss-making contracts, not only does it sort of like hit your basically hit your business, but that if it's a big, huge working capital unwind rather than a working capital give back, then that frightens me. That frightens
it does.
me.
No, that's a very good point. It's something that a lot of us would miss actually if you hadn't really crunched the numbers in detail. We saw a similar thing at Saga this week. Last week they've pushed through the sale of the underwriting business, and you think, wow, they're going to get an 80 million pounds upfront fee, and they're going to get 65 million. Oh, that clears the debt. But then they said, actually, it's cash neutral, because the insurance underwriting division, of course, gets the premiums up front and pays all the other things out much later. So that unwinds, and suddenly they're basically giving it away for nothing, effectively, in cash flow terms. So devil's in the detail always, isn't it?
Yeah, you got to look close on that one to get comfort. I haven't got the analysis and the detail. Okay, got a last question coming in from a couple of people actually. Dar Mazar and Ben Sharman are asking about your latest thoughts on Zigup, which we did chat, I think, about last week, which is basically the white van rental stroke servicing business. Very, very, very cheap. Plays a big dividend, if I remember.
I prefer the old name Redde Northgate, because those are the two divisions. The Redde division does the credit hire cars for insurance companies, and the Northgate business is a white, buys huge numbers of white vans and then rents them out and makes a profit on it. I don't understand why it's so cheap. This is so ridiculously cheap at the moment. PE of 6.5. 8.2% dividend yield, and those divvies are really reliable. It's actually below its own trading. I think, didn't we talk about this last week?
We did, yeah.
0.9 times net tangible book value. The only downside I could find on it was the residual values on the vehicles could be dropping, but that's in the forecast already. So I really like it. I think it's dirt cheap. I don't understand why it's this cheap. So I like Zigup.
Yeah, I think you've probably nailed it there, Paul. The market is concerned about residual values on their vans and whether there's any, because it did take that huge spike up when they got used vehicle prices went through the roof. But that was a long time ago. You'd have thought actually that have fully unwound, particularly as they run these vans really hard, and so the lifetime of these things is not. I think you probably just need to have a really good look at the balance sheet. If you get comfortable with the balance sheet, then frankly, you're right. It looks like a money printing machine to me at these levels.
Yeah, and you're buying a pound for 88p, basically in balance sheet terms. So I really like Zigup.
Right, brilliant. Okay, well, thanks very much, guys, for all the questions. We've covered a massive amount of material in this bumper Christmas edition. I'm absolutely salivating to hear Paul's top 20 for 2025, and if he's going to send them out or it's going to be premium for next year. I will send him a copy of mine sometime between Christmas and New Year, and we'll reveal him in reveal him in January, and he can be the adjudicator to see who's in the header up. But it's only a bit of fun, obviously. So thanks a lot, guys, and thanks very much, Paul, for all your marvelous input, and really look forward in reading more of your comments for the Substack for the last few weeks.
Yeah, thanks, Paul, and obviously Merry Christmas to everyone. Have a lovely break.
Yeah, great. Thank you.
Cheers, then, Paul.